The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, how did the markets fare headed out of the long Labor Day holiday weekend? Did we see any major movement in the grains and in livestock trade? Well, it appears not so much. We're going to talk about where things stand here as we're getting into the month of September. Joining us today, Brian Splitt with agmarket.net is our guest analyst. Brian, good to have you back on Market Talk, my friend, and hopefully you had a good holiday weekend.
Yeah, good to be back as always. I was outside a lot, if you can't tell. Had football games and fall baseball, so got a little cooked, but
got a little sun, nothing wrong with that. I got a little sun in the pool on Monday afternoon myself. You can't really see it, but I'm also very pale, so even a little bit of sun does wonders to me. But
yeah, this backdrop always makes me look red too, so.
Well, hey, you know what? Glad you were able to get out and enjoy the holiday weekend. I know a lot of folks were able to do that as well. And, you know, the markets coming back on Tuesday, man, Brian, feels like the markets were kind of still out on vacation. Didn't really have a whole lot of movement. I mean, corn was in like a 10-cent trading range throughout the day. Soybeans were a little weaker. Wheat was up a little bit, but man, oh man, tough finding a news story or a news headline to really drive the markets coming out of the holiday.
Yeah, if you were on Twitter over the weekend, you'd have thought this market was going to open sharply higher. I mean, it was nothing but talk about how poor the crop is and the finish is horrible. And I'm not going to say that it's not, but you know, we also did just have beans go up about $1.25 from 12.80 to 14.10. So we have priced in some losses to yield. But yeah, it really was a disappointing session considering all the hype that we had leading up to the open last night. We tried to rally. We did start higher. And then really it just turned into a day where there was some unwinding of fun positions. So they sold beans, which they're long. They bought corn and wheat, which they're short. And it just turned into a day of evening up positions rather than new money coming in and saying, hey, we've got a conviction that we're going to go up or down from here.
That's kind of what it felt like to me as well, is that, you know, maybe a lot of traders deciding, hey, let's get some short covering done here in corn and wheat ahead of not only the Tuesday afternoon release of the latest crop conditions report, but, you know, I know, Brian, as well, we got a WASDE report coming up next week on Tuesday. I have to think this market's maybe getting ready for that because that September report known for its market moving surprises, isn't it?
Yeah, I mean, traditionally, when you see the yield go down in August, we can expect some further deterioration in the September WASDE report. So I do think there's going to be a period after this pullback. You know, it's a little over 50 cents off of last week's highs in beans. And we're very close to testing the uptrend. We've got some major moving averages just below us. So if there is a little bit of additional downside into that 13.45 to 50 area, you're going to start getting into all of that. And if it goes there, I would expect some buying to come in and support the beans going into the report. We just know the balance sheet really can't handle that much of a yield reduction from here. We're going to have to start seeing higher prices that will start rationing some of the demand. I don't know if that's going to come in the crush demand because we do have new facilities coming up, and maybe if anything, high priced beans could delay some of those projects. I don't know, but I think it's more likely to come. The immediate impact would have to come from the export side of things. But the corn balance sheet just has a lot more wiggle room. There's still an awful lot of demand that is in there that I think that USDA can bring out over time. There were some comments on Twitter over the weekend. You know, when was the last time the the USDA missed demand big, in their first estimate, and we just lived it. That first initial demand number for corn for this 22-23 crop versus where they just had it in August was an 880 million bushel difference. So it's almost 1 billion bushels demand that didn't show up that the USDA thought was going to, and a lot of that was China. And I don't know that anybody really knows how much China needs to buy. They came in and they bought a bunch after they recovered from African swine fever. I think a lot of that was because values were so low after everything got hit so hard from COVID. Everything was cheap at that point. So that's a big question mark. Do they need to buy more? Are they waiting patiently? Did they stockpile and they're good for a little while? I have no clue. And only China knows that. But we're going to have to really start seeing somebody besides Mexico, which has been a very steady buyer. That's been our most consistent buyer lately. But somebody else has to show up and start putting up some big numbers to start eating into this gap that continues to build for our demand.
Well, thinking of corn and beans here in that demand picture, we know it's been rough, it's been ugly. Thinking though, chart wise, you look at 480 D's corn, for instance. Let's start with the corn market. I mean, we've talked about this before. I feel like if we were to break through some of this support right around this mark, I mean, we'd have to be thinking 425, 430 targets for D's corn. I mean, what's your thoughts here heading into a report next week with just if we were to break below some of this support right now in D's corn?
Yeah, so I think there's two outcomes here. We're trading sideways, right? We had the August WASDE report. USDA lowered yield more than trade thought. We tried to rally early in the session. We failed and finished lower. That was a 507.5 high that day. Then we had the trade coming out of the weekend leading up to the Pro Farmer Crop Tour. Again, strong opening, traded up to 506.25, I think it was, and then failed again. So you have a little bit of a double top up there. And then you've got these lows that we've been making. 473.5 is the low for the move. 74.25 is a secondary low. So you can make the case of a double top. You can make the case of a double bottom. Either way, we're consolidating right now. We're waiting for what the next directional move is going to be outside of that range. If it can break out to the upside, in doing so, it would also take out the long-term downtrend that's in place from the June highs to the July highs. So that's going to all come in that same area here. Then it measures up to about 539. Would love to see that. But if we break down below these lows, then the measurement's down to that 439.5 level. And one of the things you and I have talked about over the last several months is the 2013 comparison. I'm sure I'm not the only one. I mean, the industry is well aware of that comparison. Last week, some of the daily ranges and settlement prices were exactly where we were in 2013. So I just find that absolutely fascinating. But September was a very difficult month for corn in 2013, eventually trading down to just a hair above 440 at the end of the month, which that's a quarterly stock report at the end of the month. So, if the USDA doesn't give us a big enough demand drop, or I should say big enough yield drop to offset additional demand reductions, and we're still 2 billion plus type carry out, and then we're going to see what the quarterly stocks have to say, which I'm concerned about that a little bit, because now you look at the September-December corn spread, and one thing that's different about 2013 is we were still inverted September over December at this time of year. Right now, there's a pretty good amount of carries set to D's while we're in delivery. So does that suggest that there's some old crop out there that maybe we don't know about, and our carry-in might be a little bit bigger than expected?
Brian, on the flip side, November beans, do you think we should be looking at protecting some downside risk potential, barring USDA giving us some wild surprise next week that we don't foresee? I mean, these seem like pretty solid price levels still here in November beans, Brian.
Yeah, I mean, we're not at the highs. We were $14 plus last week. Jim McCormick and I were looking at some kind of historical charts. And so a continuous chart will always show the front month, right? You can also do a continuous chart of a specific contract. So meaning November only. So for example, November 20 beans expired, then it charts November 21, and then that expires, then it's November 22. So it's only the November contracts. You go back all the way to 2000, there's really only 1 year where we spent time over 14 into fall, and that was in 2012 when we had the drought. Otherwise, $14 beans is just a tough number to hold on to. So I do think you're going to get another shot at 14. I wouldn't be surprised if it's the day of the report, a week from today. I think the USDA will lower yield, and maybe that gives us a shot higher. But it's one of those things where I think you got to have orders out there. If you want to sell $14 beans, don't wait for it to get there and then see it on your phone and then try to get a hold of your merchandiser or your broker. I think you just need to have the order out there. And in the meantime, we're just carrying puts under the market just in case. But I think the balance sheet for beans is much different than corn. You take, half a bushel or a bushel off and things really start to get pretty snug. So I think we're going to be living in a different world on beans here. And we're going to be coming up to the period with South America where if it's dry and their planting gets delayed, we're going to start building a little bit of premium in the bean market because of that. So we'll see how that pans out. But I guess to me, I do think $14 beans are a selling opportunity. I think most producers probably want to sell beans out of the field because of how well they've performed relative to corn. You think about the May low in beans, it was down around $11.30. So we're still $2 plus above that. And then you think about the May low in corn, and we're trading below that. So if I'm going to raise cash out of the field, it's beans. And then if I'm going to take advantage of carry in the market, it's corn. So I think corn goes in the bin. Maybe that impacts bean basis, especially with the waterway problems that we're seeing. So flat price is one thing, but also pay attention to your basis, because that could be something that is negatively impacted by your neighbors selling beans, by the inability to get beans out of the country because of the Mississippi River.
We are having a conversation today with Brian Splitt from agmarket.net. Brian, a couple other thoughts here on today's show. Looking at charts and technicals and fundamentals here on D's 24 corn, November 24 beans. Are you getting too aggressive or not so much with any forward marketing looking at the 24 crop at all right now?
Yeah, so as a company, we've done some light selling there. We did 10% on a hard sale for Nov 24 beans, and then 10% with a three-way, which means you bought a put, you sold a put down near the contract lows, probably around $11, and then sold a call probably up around 14. So you've got a little bit of a flexible position. I can tell you that from a chart perspective, you've got the highs that were made last year, and then you've got some fall highs that were made last year. So we're right up against that downtrend when we're trading around $13. So just from a chart perspective, we don't want to ignore that. On D's 24, we've been a little bit more aggressive there. We've got some hard sales. One of the things that we've also been looking at on corn for next year is using the March short-dated options to provide a floor during our crop insurance discovery period, which is February. So you have the ability, and these March short-dated options are expiring at the end of February. So that's the period when we make the spring average. So you have the ability to set a $5 floor if you want by buying that $5 put. Maybe you sell a call. You think about the highs that we had back in June up at 565. The July high was 547 and a quarter. So maybe you sell a 550, 560 call to help pay for that $5 floor. And then that way, if things do continue to go south, like a 2013 event where we're down at 450, in that time frame, then you've done yourself a service where you've got 50 cents in your pocket in those bushels. Then you can decide, do I want to keep this $5 sale and defend it with some calls during our growing season? Do I want to pocket that 50 cents and just add it to the kitty? But that's one of the things that we're looking at for new crop corn moving ahead.
Brian, how much are you watching crude oil right now? We're getting pretty close to that $90 mark once again here. And I know a lot of talk about output levels from Russia, Saudi Arabia, et cetera. How much are you watching crude and its impact on both grains and livestock right now?
Yeah, so I mean, crude's interesting. It's definitely been very strong, and it's because of production cuts. So we've got Saudi Arabia saying they're extending that production cut for 3 months, and then you've got Russia saying they're going to do the 300,000 barrel a day cut to their exports till the end of the year. But then when you look at the reason why they're doing that, it's because they're concerned about demand. They're concerned about the overall global economy. So it's positive and negative at the same time. I wonder if these are levels that are sustainable, but we haven't had that immediate impact of, hey, crude oil's up at 90, let's buy grains. That hasn't come to fruition yet. Hopefully it does. It'd be nice if we could get a little bit of a bounce, but then at the same time, it's like, geez, if you had a marketing plan and you've got some bushels sold in corn, you really should be wishing it just goes down right now. I mean, if you can double dip on what you've already done marketing wise, plus see the market go down into October and have that fall average at a lower price to maybe get a little bit of a crop insurance payout, that's really what you should be wishing for. I don't think, the market going up right now is only going to help those that haven't really priced many bushels. And I don't think you're even going to get a rally that is going to go back to levels that you want it to. We're not going to see $6 corn again. I think that's a pipe dream at this point. So for right now, I'm really just hoping this market continues to break as we go into October and set some lower averages.
Real quick, livestock, just want to touch on that. Fairly quiet day Tuesday in cattle and hogs. To me, it really feels like we're kind of just assessing how that Labor Day holiday demand went, restocking grocery store shelves and more. That feels like the biggest driver in the trade this week. Would you agree, Brian?
Yeah, I don't know what's driving trade right now. It seems like it's a tired market. It was down early when we started to see some strength in grains, and corn pulled back, and then we popped off the lows a little bit. But this December live cattle has got a little bit of a downtrend from the contract highs. And then it's got a little bit of a flat base of support. So what that looks like on a chart, you would call it a descending triangle, right? So downtrend, flat base of support. So one of the things you want to see on December live cattle, if we get over 186, then we're taking out that downtrend. Hopefully that brings in some technical buying and we consider that a breakout to the upside. But failure below 182 takes out that flat base of support, and then I think you're going to see further fund liquidation. And it's one of those things, the fund manager has been long cattle for quite a while. And if that market starts to feel tired and it's not paying them anymore, they may just want to get out and move the money somewhere else. So that's also something you have to be mindful of. I know there's a lot going on, people talking about, the reserve levels for banks are going to be increased. And that happened in 2020. That caused a big part of the stock market to roll over. We've got student debt repayment coming up again. We've got debt ceiling talk again. And that's probably the thing that will break the cattle market, will be not the fundamentals changing, because it takes a long time to turn that boat around. It'll be something that has nothing to do directly with cattle. It'll be outside market sentiment that breaks that. I continue to look at puts as extremely cheap in cattle. Just the volatility in cattle options is very low. They're not expensive to buy. So if you've got concerns about the economy or what have you, it's not a bad idea to just layer those in under your production.
Well, with that, Brian Splitt, agmarket.net. Always great to catch up with you. I know folks can sign up for all your guys' great intel, get a hold of you guys and more very easily online there, agmarket.net, can't they, Brian?
Yeah, go to agmarket.net and get a little free look at our intel. There's tons of stuff you can sign up for. You can tell us that, stuff you don't want to look at so we don't bombard your inbox. If you need help with any of that, you can call us directly at 844-4AG-MARKET, so 424-6758. And if you want to talk to me directly, it's 815-665-0463.
Fantastic. Brian Splitt, agmarket.net. Thanks so much for joining us, and we'll look forward to talking to you again soon.
Sounds good, Jesse. Thank you.
That's going to do it for the show today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.